All right, thank you everyone. Thank you for joining us for this webinar today where myself, Claire Boden, I'm a tax partner here at Gravita. I'm joined by my colleague Fiona, who's also multinational groups need to think about when thinking about their UK tax planning and their governance. Just a couple of housekeeping bits. As far as I'm aware, there's no scheduled fire alarm, so we should be staying here. We will be recording this webinar and slides will be sent out afterwards. We'll also have an opportunity for Q&A, so we can pop those into the box at the bottom of the Zoom, and any that we don't get to answer during the session, we can follow up with afterwards. And there will be a short survey as well. So I don't know, with that, I think we'll hand over to Fiona, who's going to start.
Good afternoon, everyone. So I'm going to be starting by talking about three topics about international tax from a UK perspective. We'll see when I talk about the group sizes that this affects. Transfer pricing is the area that's going to affect more groups than the other two topics I plan to talk on. I also plan to talk about Pillar 2, and then finally I'm going to be talking about the tax strategy publication requirements before I hand over to Claire for the other three topics that you see there on your screen. So, transfer pricing, and this is all from a UK, is transfer pricing required? So, the reason transfer pricing is so important, and it is a tax concept, not necessarily a commercial concept, is if I'm in it, just say I've got a Cayman company, if I'm able to shunt profits from the UK to a Cayman company, then UK HMRC is going to miss out, and of course there is no tax in the Cayman Islands, and obviously I'm using extreme examples here. Needless to say, HMRC doesn't like that. So if there's a potential tax advantage that's going underpaying for costs or overcharging for income, there would be no tax advantage in that situation. If it's the other way around, then there could be a tax advantage. Now, of course, this only applies where we've got connected parties. So if I'm transacting with a third party unconnected to me, transfer pricing does not apply because I've got no ability to manipulate that price. So size matters in the UK. So when we have to worry, we have a group and we've got more than 250 employees on a full-time basis across the whole group, or, and it is an or, we've got the turnover of more than 50 million euros and a balance sheet, which is just the asset position, so we don't knock off the liabilities of more than 43 million euros, then we have to worry about transfer pricing from a UK perspective. There is no de minimis whatsoever. I'm dealing with a connected party that's in a tax haven country. The proper jargon for that is where there is not a suitable non-discrimination clause in the tax treaty, but by and large that applies to countries where there's a tax haven. So transfer pricing will apply where we've got connected parties in a group transacting with each other, where there is potential type of intercompany transaction, which would include goods, services, tangible assets, intangibles, and financing. So in order to support a transfer pricing position, there is a requirement to have transfer pricing documentation. Now, if you're a UK company and you're filing your CTS, most of you will have noticed to tick, if you're an SME, so in other words, if you're falling outside of the UK transfer pricing exemptions per the size we just discussed, and that's saying that you're not within transfer pricing. If you don't tick that box, then HMRC will assume that you are squarely within UK transfer pricing regulations. Now, ideally, you wish to have full transfer report your arm's length price before you file the relevant tax return, because otherwise you're filing a self-assessment tax return to say that everything's about being done at arm's length. You've got no proof. Now, there's very often red flags which HMRC absolutely look for when they might be looking for transfer pricing risks from a UK perspective. Let's talk about a couple of them. So if you've got, say, a UK company within a large international group and there's persistent losses or low operating profits, that could be very where we've got perhaps the UK company, it might be relatively small, it might be providing marketing support services, let's say, to the parent, and it's incurring its costs perhaps for staff, perhaps for a small office to do that. But in many cases, it operates at a loss year on year on year. And we just see in the tax computation this loss ever accumulating. So something like that would certainly be raising red flags to HMRC. If there's transactions within the group with a tax haven, so for example, Cayman, BVI, etc., then that again will be a red flag, or the absence of intercompany agreements. That could also be a red flag for HMRC. In my time doing transfer pricing, I've often said to clients where it's relevant, oh, do you have transfer pricing documentation? They'll go, oh, yes, here's my one bit of paper that's £6. That is not transfer pricing documentation. At best, that might be an intercompany agreement. It's no more and no less. And HMRC will expect a lot more than that to justify an arm's length price. The easiest thing in the world is to bury your head in the sand and ignore the UK cost. There can be compliance costs. So, for example, if HMRC open up an inquiry into transfer pricing matters, that can be very time intense, can involve a lot of professional fees, tax, interest, and penalties. And there could be escalation into other issues as well. The other way to look at this is not only kind of, I don't know, we're on the naughty step and these are all going to be the costs that are going to be thrown at us for burying our head in the sand. You might actually want to put your head above the parapet and look at it as an international tax planning opportunity. Because if you have, for example, their corporation tax rates are 12.5%. If you're actually able to put substance into Ireland, then you can actually legitimately put some of the profits into Ireland, and as a group as a whole, you'll be lowering your global tax. So just moving now on to some of the changes that we've got in respect to transfer pricing. So the first one we've got is this UTPP. Now, what this is replacing something called the diverted profit tax regime that some of you may be aware of. Now, the problem with the DPT was that if any tax that fell due under that, it did not fall to be a tax that was going to be allowable under any sort of double tax treaty and therefore any double tax relief. So in some ways, it's good news that we've got the UTPP to replace that. It is penal, 6% above the corporation tax rate, so likely 31%. And what it's really doing is really trying to say, well, you should have paid attention to transfer pricing, you should have applied a transfer pricing adjustment in your tax computations, and you didn't. We've picked it up, we've issued an assessment, a directive, we're now going to talk to you about it, and if you don't get your house in order, we're going to charge you 31% on those profits that should have been declared as additional profits under UK transfer pricing regulations. Another change that's come in for 2026 for accounting periods beginning is now a UK to UK exemption from transfer pricing. That only applies where the two parties involved in the transaction are at the same rate. So, for example, both at 25%. And this is welcome news. I'm old enough and have enough wrinkles to remember when they actually were forced to bring in UK to UK transfer pricing regulations because it would seem to be non-discriminatory to not do so. But quite was really next to nothing. And if I'm honest, I've never in my entire career seen a transfer pricing inquiry based solely on UK to UK transfer pricing. So that's good news. Just looking a little bit more about this unassessed transfer pricing profits. Now, it's a bit messy before HMRC can take further action on this. So there has to be an effective tax mismatch outcome, ETMO, it's not ETOM for those of you awake, that's a little typo there, so please take note. And what this effectively says, I had to do, if I'm honest, when I was preparing for this, I actually had to just do a retake on this because there's a lot of wording around this, but I think what it's actually saying is, if should have been assessed to transfer pricing, but was not, if the foreign tax on that is less than 80% of the UK rate on that, then you don't have to, you have to worry. So I think that if the foreign tax rate on that bit, that percent, then you could be brought into this UTPP. On top of that, so it's an and condition, there has to be a tax design condition. So it has to be assumed that there was arrangements that were designed to be put in place to achieve a UK tax reduction. So just a little bit more on this unassessed transfer pricing profits. So if there is to be tax to be paid as a result of this, then it will become months and 1 day after the accounting period end, or under QIPs, the rules there, they apply. And of course, as with any other overdue tax, interest charges will apply from that due date on a daily basis. HMRC, they enter into sort of a 15-month collaboration period to discuss or almost amend your corporation tax return and put in a transfer pricing adjustment, which of course one would choose to do to try to avoid the 31%. This is really a bit of a sort of a stick, really, just to try to get companies might otherwise be. So lots of wonderful new acronyms coming in. So we're now going to look at the ICTS. So this is under consultation at the moment. This is the International Controlled Transaction, say under consultation at the moment. And what the plans are is it's going to be yet another compliance burden. Sorry, folks. And what it's going to be is it's going to be a digital form reporting cross-border transactions with related parties. And we're going to see in a moment what is likely to have to be reported on these. And the aim is to identify high-risk transfer pricing arrangements. So there's a bit of a theme here. One can only imagine the tax that they may be wishing to take under transfer pricing. This is scheduled to apply to accounting periods beginning after the 1st of January 2027. And this ICTS will be filed with the corporation tax return. Now, thankfully, for those who are operating in the SME exemption for transfer pricing, you can breathe a sigh of relief and you don't have to worry about it because you'll be exempt. As I said, you're going to look at the end of the day, but the consultation is suggesting there might be some sort of materiality threshold, perhaps an aggregate cross-border transaction in excess of £1 million. HMRC in their condoc have suggested that there could be 75,000 companies that are going to be required to file under this. I hope you're not one of them. And what is likely to have to be reported, looking to try and see if there's any transfer pricing omissions here, is the two companies involved with this, the name and the country, the transaction category type, so the goods, services, royalties, management fee that we spoke about earlier on in terms of applying to transfer pricing, the financial data, so how much was applicable. So, moving on to Pillar 2. So, in October 2021, 135 countries, actually slightly more than 135 countries, including the UK, agreeing a minimum global corporation tax rate of 15%. Thankfully, it doesn't apply to everyone. It's targeted at very large groups. So you can all breathe a sigh of relief if you have not got a consolidated turnover of more than the last 4 years. So this really is only applying to the very large groups. But it might be your relatively small company in the UK, but your group that you operate in is of this sort of size, in which case you do have to care about it. So what are the core Pillar 2 taxes? What are they trying to do here to get to this global tax rate of 50%? We've got the multinational top-up tax. Now this applies where, obviously we're looking at this from a UK perspective. This applies when we have a UK parent that has interests in entities in non-UK jurisdictions, and the group's profits in those jurisdictions are taxed at below this 15% minimum effective rate. So that's type 1. Type 2 is a domestic top-up tax, and that is imposed on UK members whose profits in the UK are taxed below the 15% rate. And you might be sat there thinking, well, how can that be the case? Because the corporation tax rate is 25%. Well, it might well be due to incentives or other credits that you might find yourself within that. This is a very simplistic, but hopefully it gives a little summary as to the two types of taxes that Pillar 2 are looking to tax: foreign subsidiaries of UK parents, and then the domestic top-up tax, UK entities of a large international group. Compliance and reporting, as you can imagine, I mean, we're just in this short presentation so far, we're just hearing about the multiple layers of more and more compliance burden and administration that's being sort of piled on here. And unfortunately, with HMRC, within 6 months of coming into the scope. And as I say, it came in with effect from the end of the group's first accounting period starting on or after 31st of December 2023. So if you haven't already given some thought to this and you are a very large group, then this is something that you ought to be considering, because as one can imagine, there's going to be penalties, etc., for non-compliance. So, and yet another initials, we're loving the initials today, another 2026 development, more initials profit rule. And this, if you will, is like a third leg of Pillar 2. And this is now active in the UK for accounting periods starting on or after the 31st of December 2024. This presentation, I think if one looks at it almost as a backstop mechanism to the UK multinational top-up regime, which just ensures that any top-up amounts that may not have been collected under the domestic minimum top-up are still collected. Right. Home straight. We're now on my last topic, which is HMRC. So again, we've got more sizes, some different to the other ones we've been talking about, some similarities. So for a UK company to be required to involve, then in the previous financial year, there has to be one of the following criteria met: either a turnover of more than £200 million, a balance sheet of more than £2 billion, or UK subs of a group where. So that one we've already seen for Pillar 2, you'll remember. So the tax strategy's got to be publicly accessible. HMRC really do expect this to be published on the website and for free. They don't expect it to be put up in a timely manner, and it does have to be refreshed every year. So you can't just do it and then leave it and sort of forget about it and assume it's still current and okay. It has to be refreshed every year. And it must cover 4 mandatory pillars, which I'm going to run through now. So this is a level of detail now that has to be the 4 mandatory pillars. So 1, policy on managing risk. So this is how does a UK company manage its risk, tax risk? What are the tax risks? How have they been identified and how are they reduced? And what systems are in place to manage that risk? Second mandatory pillar, publish on your website if you meet those size criteria. So you've got to provide details of what external tax advice might be sought and what influences tax planning. Mandatory pillar 3, what is the level of acceptable risk? You've got to state that and give details. And then the 4th mandatory pillar is working with the HMRC. How do you deal with it? And how do you work with HMRC? So there's a lot of almost quite personal corporate information. It's the size criteria for the publication of a tax strategy. And of course, HMRC love punishing those that don't comply. So there we have a number of penalties that will apply if you don't. So enough from me. I'm now going to hand over to Claire, who's going to start by talking to you about senior accounting officer regime.
Yeah, thanks very much, Fiona. More compliance coming this way, I'm afraid, but this is a regime that's been in place for some time now, and similar size limits apply to one element of the tax strategy. So if you have got a UK group balance sheet total of 2 billion, then this will apply to your group. And it's just worth noting that it's your aggregated figures. So where some things might come out in consolidation, you have to look at each individual entity in the UK and add them up. And that's all UK tax resident entities that are registered in the UK on Companies House. So what's the aim of this? Saying to large businesses, if you're going to be submitting tax returns and making tax claims, etc., then you need to be proving to HMRC that you're confident that you've got adequate tax records and accounting records to base your tax on. And each business needs to designate a senior accounting officer, and that's typically an FD or a CFO of the group, processes and pulls that all together and certifies to HMRC that they are confident in the underlying data. Now, it does apply to almost all taxes. There are some taxes excluded or some areas that you might think would be included. For example, national insurance isn't necessarily caught under this along with national minimum wage, but your PAYE obligations are caught under this, and therefore it is almost kind of consider. Now, this is all part of reinforcing the risk assessment approach that HMRC wants to take for large businesses. They expect the SAO to be on top of their processes internally and review them annually and certify them annually. And you need to appoint your SAO and part of that is noting that you've chosen the SAO correctly. They've got to have the responsibility and the oversight at a reasonable level. So as I mentioned, an FD or a CFO. It is possible to have more than one SAO if you have got a larger, more fragmented group, or you've grown by acquisition and perhaps you're still on different side each other. But what you cannot have is two SAOs operating together at the same point in time. Additionally, if an FD or a CFO changes, then that's also okay to have two SAOs for a period, but HMRC will expect notification. When it comes to your annual certification, the SAO is setting out in their certificate that their systems such as the ERP, the accounting processes, that the people in place have taken reasonable steps to establish the records, maintain them adequately and monitor them adequately, and show that they are then fit for purpose to ensure that you've got an accurate tax submission and your tax is calculated carefully and properly. Now, ideally, everybody should be submitting clean certificates. There are something that's happened in the year, say a fraud, or if the FD has changed, that person may no longer be in place and they haven't covered the whole period. So if you're not able to submit a clean certificate, my recommendations are always to talk to your CCM at that point, explain the situation, and it should dovetail into any business risk review element that HMRC or occasion where you're not providing a clean one. Now, again, penalties. Fiona's talked about different penalty regimes on the other thing she's talked about. Again, SAO isn't free. There's one penalty on the company of £5,000 if you fail to notify of the SAO. But additionally, there are £5,000 penalties that apply personally to the SAOs if they've failed their late certification or perhaps carelessly or deliberately provided a clean certificate which is proven to be incorrect at a later date, then that SAO would be subject to a £5,000 penalty. Now, unlike what Fiona mentioned about they're getting more strict on some areas, this is an area where we've seen a little bit more relaxation with HMRC. If you're not there, you're not up to speed, I wouldn't worry. Get ahead of it, and those penalties, there may be some flexibility there. So just moving on, just a few points to note on SAO generally. General risk reviews, the process that they undertake, and they want SAOs not to see this as a box ticking exercise. They want SAOs to take responsibility for the taxation. At the end of the day, for a corporate tax return, for example, that SAO is likely the person signing off the tax return, saying it's true and complete to the best process, and really know and understand and be confident that there are reasonable accounting arrangements in place. And that includes well documented that the SAO understands the system and that that's actually how the business is operating in practice and not theoretically it's okay. Now, visibility over the key tax risks as well. And therefore, they're hoping for kind of early involvement in any material transactions, anything that might need to be noted on a certification or something that you might want to mention to your CCM. And it's to get this SAO to think about these areas that HMRC may want to get comfortable in when they receive the, and this kind of dovetails into other areas such as your transfer pricing and your Pillar 2. And your corporate interest restriction, which I'm going to talk about, but also your tax strategy. So all of this should be brought in together as part of the overall governance of the group. Some of the areas where we find that issues arise is that the FD too much reliance on external advisors or other members of team within the business without carrying out the correct due diligence to make sure they fully understand the process that's behind it. And that's normal, that can happen when you've got a busy business. But HMRC are asking here that SAOs take ownership for these processes and procedures and are really confident that your tax is correctly calculated, submitted, etc. Other areas, when if an SAO changes, you might have a week handover, so having really good process notes and procedures set out so that a new SAO can really pick things up and fully understand what's gone on previously in that year. And sometimes as well, businesses, the tax team, and this is to try and get the business to take it seriously, that the SAO should be across transactions that are going on in the business, that they fully understand them and they can clearly, properly and effectively report them on their tax returns. So hopefully that's a little bit of insight on the senior accounting officer regime. I'm going to move on now to corporate interest restriction. So again, now what's the aim of these rules? Essentially, it's to limit excessive interest deductions in the UK tax net. So it's making sure that if a business is highly geared, that only the UK tent, and to cut out any of the noise around related party interest, etc. To Fiona's point earlier, if you are putting tax deductions into the UK and putting profit into another country overseas that has a lower tax rate, then that could be an upside for your taxation. Now, this is one way that HMRC can stem that tax. These rules are really quite complex. They can be little understood. There's 150 pages of legislation that talk about these rules. I would say I've probably read nearly all of them. Calculations are really complex, and even for some straightforward businesses, that it can throw up some areas of misunderstanding or misallocation. But generally, the consideration applies after your normal tax adjustments in your tax computation. So after you've determined whether or not for that individual company, whether or not the interest is actually deductible, etc. And then it apart from your consolidated figures. And normally the worldwide group is that which is defined under the IFRS rules, essentially, and you look at what would be consolidated into an ultimate parent entity. It's worth noting that it can apply to single companies, even if it's not a group. It's a bit of a misnomer. So if you've got a large single entity, you may still suffer. And there are also some other rules which apply to essentially staple entities together, where they may not appear consolidated under the IFRS rules, but there's some anti-avoidance rules in place to stop you fragmenting your groups to limit your corporate interest restriction, essentially. Now, generally, if your net interest expense of the group is less than 2 million, you would hope and assess your corporate interest restriction position. Now, if your interest expense is in excess of 2 million, then you would then look to some other ways of looking at it. And the first point is considering your fixed ratio deduction, your tax profits before interest, which is called a tax EBITDA, and your allowance there is 30%. So if your interest is below that, then you're typically fine. Now, to businesses genuinely operating in the UK that are highly geared. So, for example, if you've got an international group And overall, your external finance apply the group ratio, where you're looking at what proportion of your taxable profits is and your interest expense comparative to that. If you're no greater than that in the UK, then generally you should be able to get a deduction for your UK, such as industries where you're often very highly geared in, say, property businesses, property transactions, or public infrastructure, where there's a lot of upfront investment required to build things like power stations and public interest asset, and an election available where you can elect into this specific public infrastructure election regime, which would allow third-party interest to be deductible, even if you are very highly geared. Now, what's the next step? So group, you calculate your tax interest, your tax EBITDA, then you might end up with a disallowance under these rules, and you have to allocate those to the appropriate company. It's worth understanding that actually, if you have a disallowance in 1 year, there is still the possibility to kind of reuse that, or if you've got a spare allowance in 1 year, you can reactivate that in the future. So those rules are in place, have peaks and troughs of their interest expense, so that if you fundamentally have a high level of expense in 1 year, but a low level the next year, then you can smooth it out. Now, I think it's just really important to understand that this can be a really big aligned to the tax rules. So you have to have that understanding of the rules and go into your interest expense amounts in detail and make sure you're allocating them correctly within the calculation. And getting to your tax EBITDA can be your returns are due with your corporation tax computations in the normal time frame, so typically 12 months after the end of your accounting period, and you've got the choice to, if you have a disallowance or a reactivation, you want to submit a full return. There are abbreviated returns where you might not have a disallowance, but if you submit that, that enables you to kind of keep back any future allowance in a 5-year period for a reactivation. So again, more compliance, unfortunately. So where you might fall down is if you have got a group in place where you might have some guarantees on your interest. So it might appear that it's in there. It's just worth noting that groups can end up falling into the connected interest rules because of that guarantee. Also, another area is foreign exit, and if you might have some capital transactions in the year when you're adjusting your tax EBITDA, when you're looking at the group, those are areas where you need to kind of pull all of that together. Now, I'm just going to close off this section. We're just saying, just make sure that you're considering the impact of your corporate interest restriction on your tax accounting and what that might mean for the senior accounting officer with something so complex. How can you make sure that they are confident that they understand that the systems, the ERP, and the backing information collects the right data that's needed to ensure your CIR is correctly calculated? Obviously, there's advisors out there that can assist with all of this. The other bits is quite often the CIR is left to the end. It can take time. So also, it can impact on your quarterly instalment payments. And if you haven't done an upfront assessment on whether or not you've got a disallowance for your CIR, you may not have calculated your quarterly instalment payments because quite often that needs to be paid way in advance of your deadline for submitting the CIR. So I'm going to move on now to another topic, corporate criminal offence of failure to prevent the facilitation of tax evasion. So it's a bit of a mouthful, that one, Fiona. Now, this rule has been in place for some time, and there are still a number of businesses that are not aware of this rule at all. To every single company in the UK, and there are no size thresholds, so at least you don't need to double check your thresholds, as everything else we've talked about today is threshold driven. So what that unfortunately means is if you are a company in the UK, you are within these rules. Now, the aim of the rules is to for behaviours that may facilitate tax evasion. Historically, if someone was evading tax and they're not connected to you or they're not part of your actual business, you could just say, well, not on my watch, it's nothing to do with me. Now, what HMRC have tried to achieve with these rules is to get businesses to say, hang on a second, if I'd have just looked at, I might have realised that they were carrying out tax evasion. Now, HMRC's view is that if you or an employee or an agent or someone connected with you knowingly assist someone to evade tax, then that company can be caught and therefore we're on the hook. Now, equally within that, the lack of knowledge by the management is not actually a defence to these rules. So the senior management of the business cannot. You have to review your processes, your procedures, and your interactions with your associated persons and make sure that you're confident, or as confident as you can be, that you're not helping them to evade tax. So we move on one more. Kind of tax evasion. Now, I think it's probably worth noting that these rules do not cover tax avoidance or tax planning, where tax avoidance is the use of planning to effectively reduce your tax in a legal manner. So tax evasion is where someone is clearly illegally not paying their tax that they should be paying. Now, again, similar to senior accounting officer, it does really cover all taxes. And equally, whilst this is a UK law, there are some other countries bringing similar, if overseas taxes are evaded as well, if there is a UK nexus. So if there is a link back to the UK, or if someone related to you within the UK helps evade an overseas tax, then it can still apply. Now, associated personnel of your employees, your agents, your contractors, suppliers, customers, if you've got a JV arrangement or you've got an overseas group. So it's worth understanding that it does go quite far, and HMRC are essentially help protect the UK tax tape. Now, this is a criminal charge. So there would be unlimited financial penalties if a charge is taken to a company through public orders, and there will be from that a wider commercial impact and an impact on the senior individuals that are involved. And the only protection to these laws is to have reasonable prevention procedures in place. You kind of take charge, pay attention to if someone's evading tax, etc. Now, HMRC aren't expecting everyone to hire an army of people to investigate tax evasion. What they want is you to have reasonable prevention procedures. So if you're a small business, what's reasonable for you will be different to massive corporations that are international, that have a huge back office function but there are minimum areas where HMRC expect you to have carried out these activities. And HMRC set out 6 to have a risk assessment in place. I'll talk a little bit more about that on the next slide, but essentially, if you haven't done your risk assessment in relation to these rules, then it's very unlikely that you've got a defence in court if that happens. So that is definitely the first one. Then the next element is, do you have proportionate procedures in place? So depending on your size, what is proportionate will vary, but procedure would be not to engage in any supplier that's not registered for VAT. Therefore, you know that they are carrying out their obligations under the VAT rules. HMRC expect top-level commitment, so the senior management of the business to really buy into these rules and push the right culture down through the business, and that includes training and carrying out due diligence on the people that you're working with, and also monitoring and reviewing it regularly. Just the next one. So, and making sure you've got reasonable procedures in place. we would look to a business's supply chain and look at all of those touch points with those associated persons that I've mentioned, and really understand whether or not we've got some gaping opportunities for suppliers to take advantage. You know, can people invoice without the correct VAT rate on the invoice? Are monies being sent to a different country and not actually to the right country and therefore the right tax authority? In terms of your employees, have you got multiple people on the payroll? You know, someone's earning 36,000, but it's being spread across 3 payrolls to the basic rate threshold, things like that. When you've got goods moving between countries, are your customs declarations correct? Are people reviewing them to make sure the right codes are on them, the right levels of duty are being paid? And quite often a third party may carry out those responsibilities for you, but that doesn't remove your requirement to check that it's correct and that the right customs duties are paid. And that's customs. If you're shipping things from overseas and not paying the relevant customs in between those countries, but it's ordered from a UK person and they know that they've got someone in the freight company that will say, oh, I'll just put on a code and it will reduce your customs by about 50%. So it will save you costs. And you may have an employee in-house in the UK that says, actually, that's a great idea because I've got things that these rules are trying to avoid. So my question to you on this one is, have you done a risk assessment? And if not, I would recommend you get looking at that and understand to look at what your reasonable prevention procedures are. So a lot of compliance, a lot of hot topics and many things to talk about. But I'm going to move on to a little bit of a survey I think will pop up as well. So if you want to pop in your things, hopefully that hasn't been too much for everyone. There's a lot of compliance, but albeit very important things that big businesses need for their governance. So there's been one question come through. Our questions is, how does withholding tax fit into doing business cross-border?
Great, no, thank you. Great question. So withholding tax is yet another international tax concept, which I'm going to just answer that question from a UK perspective. So, for example, if a UK company is paying interest to an overseas company or perhaps paying a royalty to an overseas company, then the start of a tenure is there will be UK domestic tax on that payment of that. Thankfully, we have many double tax treaties with the UK, and we take interest as an example. Then under many of the treaties with the UK, that 20% domestic rate of withholding tax on interest will be reduced. Under many of the European treaties and others, it goes down to 0. But with interest, unlike royalties, you can't just go, I'll just look up the double tax treaty, it's with country A. Oh, great, it's 0. I just won't. With interest, and this is not the same for royalties, to apply the treaty rate, let's say 0% under a particular treaty, you have to apply to HMRC, or the lender has to apply to HMRC to apply that treaty rate. Now, that can be done by one of 2 ways. There's the old-fashioned way, which I'm very familiar with because I'm old-fashioned, which is under the treaty. Now, that can take up until you get that answer through from HMRC. You cannot apply the treaty rate of 0. So if you're physically paying interest, you have to be withholding that 20% tax. The other way is under a double tax treaty passport, which was introduced, feels like about 8 years ago. It's probably long because my perception of time goes with age. But anyway, so if you apply for the double tax treaty passport, that can come. Lender's got that, then the borrower is able to pay the reduced rate of withholding, which might be 0%. Until all that's in place, if the UK company, my example, is paying interest, and it has to do yet another compliance form called a CT61, which is a quarterly form that has to be submitted with details of the interest paid, tax withheld, etc. Now, once upon a time, and this unfortunately is a relatively recent change, if someone, perhaps in a group of companies, perhaps a UK company was paying interest to one of the overseas companies, perhaps in his group, what to think about withholding tax. Once upon a time, you could almost do a bit of a begging letter to HMRC. Oh, we're really sorry, we've been doing this for 3 years. We know we can claim that withholding tax back, because once you've registered, you can claim that withholding tax back. Sorry about that. Is it okay we just pay the interest on the late payment of that withholding tax? The answer these days is no, you cannot do that. And it's a real withholding tax. They will be liable to interest on the late payment of that withholding tax in any event. And then they have to apply via the treaty and to HMRC, the lender that is, to get that money back. So it really is very expensive from a compliance point of view and a cash flow perspective to not get this right. Just one last thing to mention on withholding tax. Yes, there are treaties apply if that interest, in my example, is an arm's length rate. So just linking that back to transfer pricing, if that interest rate is too high, so it's above an arm's length rate, even if you've got your nice double tax treaty passport in place, that treaty rate will not apply to any interest payable over the arm's length, and you do have to look at both at any point in time. So I hope that answers the question.
I think so. Thank you, Fiona. That was very comprehensive. So we've had a question in on that one.
Oh, yes. Yep. So is CCO, this is still something we really need to focus on, and how long has it been around?
So CCO has been around for a good few years now. Area that HMRC are interested in each year, or I think maybe twice a year, HMRC do publish the latest stats. So the latest stats are as at December 25, and they have actually secured one charging decision under the rules, and they are actively currently pursuing 11 live investigation cases under review. And it's just worth noting that these matters they span multiple sectors. So software providers, waste services, accountancy, legal and transport. And I think originally these rules came in for the finance sector. That was why they were originally penned. So a lot of people think, well, we're not in the finance, covering all size entities. And they have reviewed a number of cases to date. And I think they are really demonstrating some kind of sustained scrutiny to these rules and businesses, and they really want to bring everybody up to kind of monitor where people might be helping others evade tax in the UK and overseas, because enough officers, but equally it's about corporate responsibility, I think. So I think it's still an important point.
Very good. We've got another question for you, I think.
Oh, look, Claire. Thank you.
So under the senior accounting officers, by having reasonable tax accounting arrangements, and to what extent can an SAO rely on external advisors, and what are the most common? Great question.
Thank you, Fiona. It's a long one. So I think I touched on this a little bit in terms of what's reasonable. So I think ultimately, if I pick one example for, if you're doing capital allowances claim, I think what's reasonable is in that it will talk about the type of asset you've got, how much it cost, when it was delivered, when it was brought into use. And that would be reasonable to enable yourself or an advisor to calculate your available capital allowances. Again, the expectation is you're using a proper ERP and it's all electronic and all accessible. In terms of what extent an SAO can rely on external advisors, I think they have to be able to, because an SAO is one person, it can be across a really large business. So it's just about making sure you are providing what the scope of their work is, and that SAO must take time to have those conversations and give themselves comfort so they can sign those certificates. So I think, was there another element, or is that?
No, I think that was the end of that question.
Thank you, Fiona. It's been really good talking compliance with you. I think we've got contact information. There were a couple more questions.
It would be the button would work. Sorry about that, folks.
That's all right. There's a couple of questions we haven't got to, but I think we've got email addresses, so we can respond to those. If anything comes to mind that's been triggered during this, then we'll be happy to hear from you. And I believe we'll be here doing a presentation with you, Fiona.
Yes. And likewise, Claire. And thank you very much for your time, everybody. Thank you. Enjoy the rest of your afternoon.